Manufacturing activity weakened in several countries just as investors await monetary policy decisions in the U.S. and Europe. Shares in Nokia surged among speculation that Chinese PC maker Lenovo may be interested in the struggling cell phone maker. I'm Taylor Schrantz, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Lindsay Bell with The Street, and together we bring you the morning call. Overnight, we got a number of PMI numbers from different countries across the world, and that just showed more slowing, which goes with the theme of global slowing economic growth overall. The question will be, will there be stimulus and policy there to counteract that? Today we get the decision from the Fed. Scott, what's the market looking for?
At this point, the market's been on pause or in digestion mode ever since last week's big gains. You had big gains on Thursday and Friday based on the fact that the ECB, Draghi said that they're going to do everything in their power to keep the euro together. So with that said, it's pretty important what goes on tomorrow with the ECB. Some are actually even starting to say now there could be some shock and awe instead of a pushback. But today for our meeting or our release, I don't think the expectations are high at all. I think they're going to remain dovish. Maybe they say, okay, rates will be low till 2015 versus 2014. But everyone kind of knows that if things get bad, the Fed will do something. It's just a matter of when. And I don't think the when is tomorrow. It could be September. And if things keep going the way it's going, where you could just say you're going to do something and the markets continue and the data just keeps muddling along, they might even wait till after the election so they don't have any political impact.
That's a good point. As you mentioned, the S&P is up almost 10% so far this year, and over the last couple days as we wait for these decisions, it has kind of been unchanged. Right.
I could see if we fell apart this summer, maybe everyone would be forced to act because everyone thinks that, the dual mandate is for the economy and jobs. But, I know they also have one eye on the stock market as well because that's where the media obsesses. And if you look at the chart of the S&P, you'll see ever since these June lows, okay, we've had a methodical move to the upside. And then if you look right around here, it looked as if we were about to fail. And that's when, Mr. Draghi came out and said, or gave his rhetoric that they're going to do whatever they can. And then a lot of other countries, Spain, Italy, even Germany, they start to, repeat the same language somewhat. But, obviously Germany a little bit against it. And then the last 2 days, we've been digesting above what I've called, an upper level floor. We've been digesting above this 1375, which is right above this recent downtrend. So you do have a lot of shorts pent up here, and you also have a lot of people out of the stock market. So if we don't pull in, below 1375, or even if we do pull in a little bit more and we hold, the middle of this range versus doing what we've been doing all summer to the top end, to the bottom end, to the top end, to the bottom end, first time we hold higher, you're going to see kind of a spirited move above this 1391, and then we're really about 2% from the highs of the year, with everyone ranting and raving on how everyone hates equities. Bill Gross saying the equity culture is dead. P.S. I do think within the next 2-3 years we're going to be at all-time highs in the S&P.
Well, that's an optimistic way to look at things. In the sector spotlight, we're going to take a look at the retailers because tomorrow they report same-store sales for the month of July, which most analysts expect are going to be pretty decent. Part of that's because they're up against easier comparisons. But the retail sector in general has been a story of the high end being under pressure and the low end doing much better. But if you look at the RTH, you wouldn't know that.
Well, the RTH has a lot of the big boxes in there. They have the Walmart, they have the others. So if you look at the RTH, a lot of people say retail's been dead. They've been saying it, I don't know, for 3-4 years, and retail's been the place to be in select spots. And if you look here, you'll see that, from May, you have had another nice move from those lows all the way to the highs. This is one of the few groups that actually have made 52-week highs in this last push. Last 2 days, we kind of pulled in a little bit. So no big deal. You have the 8-day moving average right around 42.65. So overall, this group is showing strength at highs well before the spiders and well before most other sectors.
Coach, though, on the other hand, was down over 18% yesterday when they reported earnings. The disappointment came with the sales number here in North America. Same-store sales only increased 1.7%, which compared to analyst expectations of 6%. Where they went wrong is they eliminated coupons in their factory outlet stores, which is a big business for them. But it just goes to show that the consumer is still, really paying attention to how much they're paying for each product, and they're not willing to let go of that discount lifeline.
Right, so the consumer's getting smarter. The world is getting smarter, getting more efficient. Everyone complains, even the companies in corporate America, they're saving their cash, they're streamlining their operations. That's how you have to get ahead. And as far as almost using like a little common sense, we are in a sluggish economy. People aren't, a lot of them aren't making the same money they used to. Everyone's not using as much credit card. So, who would get pressured? You would think the high-end areas like Coach, like Tiffany, like some of these other ones that technically have fallen apart. And if you look at Coach, it gave you signs well before the earnings. Look at this head and shoulders top here in Coach well before, the earnings shortfall there. This was one area to get out of the way. Then it came all the way back and retested this breakout here. This breakout happened in the beginning of the year. Usually you test it, and then you bounce and you continue higher. But if something's wrong, you test it, the bounce is lethargic, and then if you break it, that's your stop. So you've had a place to get out right here, a place to get out right there, below the 200-day, and now look at it. So now if you're still in there, you're somewhat trapped, and it's a hard spot to be, considering you're now coming into major support down here at 45, or even a little bit higher here at what is around 48. So I would say at this particular point, if you're stuck in Coach, there's not much you could do about it. If you're looking to buy it, I would wait till it gets down to this area and make sure you do it with a plan, because it could take some time, because this chart is just, crushed.
Tiffany's is another one. They've been on a downtrend since March, and when they came out with earnings in May, they cut their estimates. They cited the slowdown in U.S. and Europe. So this is another one that it's hovering around its 20 and 50 day. I don't know if it's going to be able to break up to the upside.
Well, it's also below the 200-day, so it's showing that it's below all those long-term averages. And this one too broke down early. A lot of people, I hate to say it, aren't going out and buying Tiffany dishes and serving pieces. And if you're getting engaged, you're probably calling your Uncle Louie instead of going to Tiffany's and paying full retail. Anyway, not everyone has Uncle Louie, but with that said, you look at the chart of Tiffany's, and here's your high, here's a lower high, lower high, lower high, and look where we are, below the 200-day. And at this point, technically, it hasn't given you much reason to buy it. I think at this point, I hate to say it, if you look on a real macro level here, this is a huge, almost distribution pattern with with this gap down not getting filled. So at this point, I would remain in avoidance. I don't think you need to short it, but if you need to short things and you're some type of hedge fund, maybe that's what they're doing. But at this point, as an investor, continue to avoid Tiffany's. The
latest disappointment was from True Religion last night. The stock reported earnings, they missed estimates, and the stock was down 10% after hours. And, it was disappointing here. This high-end retailer lowered guidance on sales slowdown.
So True Religion, another one. So you look here and look at the chart. Look at this hole in the chart, but before this even recent one, what went on here? This is huge. Never even filled it, went sideways. I just think at this particular point, another spot where people aren't maybe spending $400 for jeans. Actually they don't spend $400 for jeans there. Maybe they're going to Costco, or they're going to Target, or they're going to Walmart, and they're getting a nice pair for $30 versus $150. I don't care what the the kids say, but at this point, that's the way people are handling their economic environment, and that's rightly so. So that'll make a stronger individual with stronger balance sheets, which hopefully one day will lead to better times here.
Let's take a look at some of those retailers that are doing better. Costco this morning came out and reported same-store sales of 5%, which was better than the estimate that analysts were looking for, 4%. And like you said, I think people are trading down and going to Costco over buying their jeans as True Religion.
Why not buy in bulk and get things done and be smart, be cost conscious? And if you look here, look at the chart. Much different story here in Costco. We've had this off the chart so many times. Remember when it broke this downtrend in late May? This was your buy price number one, and then ever since it's been flagging and moving higher. Here is your flag, another entry, another nice consolidation, another entry, and now here we are near the high. So I wouldn't say at this point go and chase Costco. There are prices to get it at, this being one, and then when it broke above this pivot right here was probably your last entry. But I'd say it's acting well. You could stay with it as long as it continues this trend. You could say you could follow the 20-day. Stay with it until it breaks this 21-day. Breaks the 21-day. We talk about high-level and low-level stops. That's your high-level stop. So at this particular point, it's acting very well, and I think it's rewarding investors for staying the course.
TJ Maxx is another one that's been acting very well, and I think it's just probably like Costco. You got to pick your spots to get in because it has been doing so well. It's expected to report a good number tomorrow. Again, it's the story of the value retailer doing better.
And look at this trend. Look at the chart. I think my wife goes there every now and then. She doesn't really admit it too much, but anyway, look at this chart here. Look at this nice long uptrend. Woo-wee! Doesn't you could be a fifth grader and just put your ruler and put a piece of paper, and there you go. It's tracked it the entire way. Above the 8-day, above the 21-day. You take a closer look. You follow trends till trends change, and right now it's still following it. I would say, like I said before, high-level stops. Perhaps this is your high-level stop just in case trends change, because every single quarter we see some type of rotation change. So stay with this one. It starts to break below 43.50. Maybe you sell some, and at this point, here's your resistance. Right now it's in a channel going sideways. And my rule is I don't take stocks into earnings. I trade them after, but as a long-term investor, you need to, you've been holding it for so long, you have to hold through earnings because that's a thesis and that's what you have to do if you're going to hold things for multi-years. So just at particular times, be hedged. You could sell in-the-money calls just in case you're worried to grab extra premium and be safe into that strike price, or even, do a collar. What a collar does is you sell some calls to finance some puts. So this way, if there is a misreport or a bad announcement, you're a bit hedged instead of just being a straight long only.
Well, we're going to take a quick commercial break and get back into the trenches right after this.
Hello, everybody. My name is Pete Renzulli, Chief Marketing Officer of T3Live.com. I'm really excited about introducing you to and inviting you to the first T3 Live Active Trader Summit. There's going to be a ton of great content, but the number one reason you want to come is you want to be able to network and associate with other like-minded people who have a burning desire to learn how to be a trader. So I'm going to ask you to make a trade. Trade one Saturday for some of your time to come down and learn strategies, tactics, techniques, and put some faces to the people that you see in the virtual trading floor in T3 Live, and learn to take your trading bigger. Learn how to be a better trader than you are now. Learn the strategies. It's going to be a lot of fun. Go to T3Live.com and register. If you would like to join us at the post-event cocktail reception, you can also upgrade to either premium or VIP. That's up to you, but either way, please take advantage of the general admission, 2 free tickets. Bring a friend, bring a neighbor, bring a wife, bring a girlfriend, maybe bring both, but come down and expect to have a great time.
Welcome back. We're going to get into the trenches with some overbought stocks. We'll start off with Sprint. This stock was $2 not too long ago, and recently it's been trading above $4. It got an upgrade last week by UBS, but overall it's still pretty hated by the analysts, so maybe there is still room to get in.
I think it took so long for this stock to go that people just love to hate it because they were in it, and then once everyone throws in the towel, that's when it goes, and this has been a very big move. There's actually even some stories being written that it's one of the few stocks that Apple might take over to get their own network at some particular point, so who really wants to be shorted? But from a chartist point of view, yesterday was the first sell signal after a really nice move, so it could pause here. This was your first little buy strategy once it broke above 260. Then it gave you not a blaring pattern here, but once it started to get above 3, it was on its way. And the last was this gap above the recent resistance here of 373, and it's just continued on a tear. Yesterday, you had an outside day where it traded through the previous high here of 451 reversed. So that right there says it's due for a rest. I say if you're a Sprint fan and you want to get involved, I would say wait for a pullback, try and buy it right around this 410 area. That would be it holding the 8-day. It's also come into the 21-day a few times. So on this particular stock, if you're a long-term fan and you miss this move, I'd say if it's really strong, it'll hold 410. And if it has a nice, bigger pullback that takes more time, you could still see around 380 right there on Sprint.
Metro PCS also had a recently jumped last Thursday on a great earnings report. It was up 26% on the day. It's been able to hold that gap up, but will the momentum be able to continue?
At this point, it's holding higher. We'll use our retracement rules, and right now it hasn't retraced much. You're seeing a bull flag form here in the stock. I don't really trade it. It's a cheapie. If you look at it, it had a huge move. You want to put in some volume, go to your basic formulas, put in volume. It's probably on huge volume, which it is right there. Look at the size of this volume. Broke it out, gap and go, and it's holding the top 20% of this move. So at this particular point, it's digesting. I would say some traders will be watching it. If it could get above this 915, you could see continuation. So at this particular point, it's proving that buyers are coming in higher. It could even pull back to this area, this 794, and still be considered strong. So for this to remain strong, I would say your line in the sand is 794. If it stays in this flag type pattern, it'll probably move faster than either bears would want or people waiting to get in would like to see.
Expedia also got an earnings pop on Friday. The stock was up 20%. They saw international and domestic bookings up, and as well as good hotel growth. The stock's been pretty good, though. Is it compelling to you?
I don't like this whole story of these online travel companies, but everyone is betting against them, and they keep coming out with good numbers, and they're squeezing everybody. You know, I know Mark Sperling from Floor, one of the head traders, president, has been trying to buy it, and he's been doing well with it. You know, if you look at just the chart patterns alone and take the name out of the play, look at this big gap up that you saw back here in late April. Never filled the gap, and we talk about if stocks don't fill their gaps, they continue in that direction. Depending on your time frame, you had another nice move right here. Broke it out, and ever since then, still holding higher. Then it got a little faulty. A lot of people would think we're downgrading it ahead of numbers. And then here's your gap up again. So a lot of people are trapped. Bulls are getting paid for staying in the technical course. You have another nice little flag type pattern. I think guys were trading it yesterday in my office when it crossed this high yesterday. This high yesterday was 56.68. And now if this were to get above the high here from earnings, which was 58.40, you're going to see another squeeze, another move to the upside. So as of right now, it's holding in there very strong.
ENSCO is a stock that is up 29% since its June lows. Stephanie Lincoln, Action Alerts Plus, had owned this, but last week she actually sold out of it because of that pop, and she's switching into another name, Schlumberger. She likes that one because it trades at a discounted valuation to its historical average, and also she just likes the risk-reward better there. It hasn't had the run that ENSCO has.
Yeah, this one had a nice move, so it's good. If you could buy low, sell high, it's not that's the strategies that we all try and use. And if you look here at the stock, from below 45 all the way up to 55 with a decent sized red day yesterday, it makes sense to ring the register. And as far as Schlumberger is concerned, it had a nice move off the lows also, holding higher. This was this inverted head and shoulders pattern that we pointed out, where you had the left shoulder, the head, the right shoulder. Here was your last buy price when it did cross above the 67. Nice move above all the moving averages. I'd like to see this hold this 70 area to show some commitment. And if it could do that, then it starts to move above this recent high here of 73.47, and you could have continuation. But the stock this quarter is acting much better because, since March, it's been dead for sale until you finally had this reversal pattern, this lower pivot. And now let's see if we can go, or hold sideways here to break what has been, more of a in-place downtrend. Actually, it did it right there. Look at that. So let's see it hold above this level, prove it could hold higher, and then I think it's in the game for the end of the year.
Great. Let's do some quick hits. We'll start with StarBucks. This stock, it's been on a downtrend since reporting earnings, but yesterday you were out there telling people to cover their shorts.
Yep, I think at this particular point, if you've been short since it started breaking down and you were short into earnings, don't be a pig. Take your money, and at some particular point, I think there will be some kind of reversal strategy. I like to take the meat and potatoes of a move. I don't stay there for the juice because we talk about how the juice gets a little slippery. And at this particular point, you look at the chart here of StarBucks, and you will see that this was when it started to act very faulty. Right up here, you had a breakout, failure, lower high, broke this area, and ever since wasn't able to reclaim it. This last pivot to the upside, it came back up, couldn't get above. You have a double top right here. Then it also traded lower, couldn't get through this. And then earnings was a shortfall. And then now you have this bear flag type pattern here where, it paused after earnings and then broke below this pivot, which a lot of guys made some quick money short below 46.12. And now we'll see. This is your pivot right here. This is the low of 45.09. If it trades through, makes the low, comes back above, we all know that's what's called the red dog reversal. That's the only way I'll be buying it. I'm not going to be buying it doing a cost average game because there's no reason. You have some big support right here, so see how it handles this 44, 45 area, or see if we can get some type of red dog reversal using 45.09 as your pivot.
U.S. Steel, this stock was up yesterday on earnings. It started reaching resistance levels of 21.40. Can it break through?
At this point, it closed near the highs. It's been an unloved stock, so people weren't expecting much. So when you're not expecting much and you have a stock heavily shorted near the lows of a year, you could have some type of big time trade. But then it needs time to digest, and then you have to judge the digestion. Same old story. So you look here at the chart of X, and you will see, this was a really big move. Obviously look where it was this year. It was as high as 32. Broke down. This is when it broke down below this last wedge type pattern to the downside. So if you technically, you should have been out of the way. And then coming in here, it was off the lows. You had a little bit of a pivot. Guys were trading it intraday because they didn't go into it with it into earnings. It closed a little off the highs. I would say into this supply here, it's going to have a little bit of trouble, but I would say as long as it tries to hold maybe $20 or the top third of what it gained yesterday and doesn't just fall apart, there could be some commitment. And then at some point later this year, it starts trading through 22. You'll get some momentum to retest the moving averages, which will probably be curling down to about 24. So right now, give it a few days, but from the lower level and you see the volume, some guys covered and some fresh money probably came in.
AIG is a stock that Stephanie Link owns. She was trimming it yesterday, though, because the lockup on the Treasury shares expires on Thursday, and they're expected to issue shares through a secondary offering, which will come at a discount, which is why she trimmed.
Well, that makes sense. So at this point, I haven't traded this. This is like 2 summers ago was our go-to stock. It would go up 20 points in a day, and ever since, the last year or so, we had a nice trade above the 200-day early this year, but now it's in a channel. You look at the channel here, probably needs more time to digest. The low end 30, high end 32. I don't think you need to be involved with this name until it starts trading above this 32.60, and I think that's not going to be so soon.
And then lastly, Apple, it's trading almost where it was before earnings.
Yeah, this one, a lot of people talked about the strategy. I tried to talk about it in here, saying I think that quarter is not going to be great. I'm not taking bullish calls into it for the first time in a while. If you're an intermediate trader, maybe you step out of the way and then see if you get a viable strategy. Well, it really played out to the storybook, and some people executed on it well. I don't think I executed it on the way I would have liked to. But, the strategy was if you get above 580.80, you could get another nice move to fill the gap. And boy, did it fill the gap. You look at the chart here, you will see, take a close look here. And this was, your gap down into support. I was talking 560 to 565 and went as low as after hours 565, but then really held about 570. Here was your trigger. Okay, when it triggered above 580.80, this was your spot. So for an active trader, it was an awesome 2-day trade. You bought it here, closed high, you take some home, you had a gap up, there you go, that's your day and a half trade. No one really thought that it would be up 3 days in a row, back at resistance, and that, with that big stock split story / getting added to the Dow story. So at this point, it's up, I think around 615, which is right here, which is this resistance. Let's see if it contains this move. I think most traders would like to, like me, see this pause here, go sideways for a few days and then power through this 615 to 620 area, because once we get through that, there's really nothing in its way till 644. And as far as a macro investor, I've said it probably 10 times this year, even if the earnings were bad, I'm like, the high of the year is not in 644, is not that level. You're probably going to see at least 700 plus. Stick with the course if you're holding stocks as a trader, maneuver it. And lately, after a 4-day move, it's a little tough to be a buyer here unless you think you could take some of the gyrations. But again, if it doesn't pause, you're not going to own it. So, we'll look at the intraday tactics, and I'll talk about it on the radio as the day progresses.
Well, that wraps our morning call. So check in at the end of the day with Scott and the T3 Live team for the daily recap.